Good afternoon, everyone, and thank you for joining us for another session of Economy in Plain English. Today, we're joined by Dr. Arun Advani, and we're live on LinkedIn, X, and YouTube. So the Economy in Plain English is brought to you by the David Hume Institute and Journalist Clare English. We're on a mission to increase understanding of the economy, what it is, how it works, and all in plain English. We're on a mission to increase understanding of the economy, what it is, how it works, and all in plain English.
Time.
I'm really sorry about that. That's a technical hitch. The joys of trying all the tech and managing it all for yourself. So you have an echo. If you have any questions as we go along, please do ask us, and we will try to weave in as many as possible. So ask away, and we'll incorporate as many as we can. Now over to you, Claire, to keep us on track.
Well, thank God you're doing the tech. That's all I was saying, because I'm struggling to keep up with the economy stuff. I am the person who put the plain in plain English. I'm Clare English, ex-journalist, but I'm not economics savvy. I would like to know a bit more, because this stuff affects us all, doesn't it? Whatever we vote like, how we live, how we make decisions. So we're going to try and dissolve some of the mystery about the economy, maybe drop some of the acronyms and the jargon, and just try to dig down into what matters, what we should know about. Luckily, we've got amazing guests on this series, and today we have an amazing guest on the table for discussion. Tax. I know you're all thinking tax. It's important. We need to understand this stuff. So I'm going to hand over to Arun very shortly. But just please, as Susan said, get your questions in. We'd love you to ask Arun any of your queries at all. It's lovely to have your conversation go further than just the people that are in the panel. So anyway, without further ado, I'm going to say hello, Arun. We're delighted to see you. Lovely to meet you through the ether. Tell us a bit about yourself, where you're based and what you're doing, and we'll kick off with that.
Great, thanks. So I'm Arun Advani. I'm an associate professor of economics at the University of Warwick. And in my research, I am interested in thinking about tax, particularly at the top end of the distribution. So wealthy people or high income people particularly. But I look at tax, kind of what we call personal tax, so for people rather than for companies, kind of across the piece. And I should also say I'm co-chair of a charity called Discover Economics, which is all about trying to increase access to economics. So I'm fully on board with the mission that Susan at the start.
You're just the man for the job. But I want to ask you, as a fellow human being, and everyone else assumes that economists are geeks, which is, I don't know, is it right or wrong? How did you? Right, well, right, there you go. This is interesting. So where and when did it occur to you that you wanted to make your career studying the economy? At what kind of age and stage?
Yeah, it's interesting. I definitely didn't start out thinking I would be an economist. I mean, I went when I was at school. I studied economics as an extra subject on the end of the other things I thought I was going to do. Didn't really know exactly what I was going to do, but it was the extra thing. I ended up actually going, because not all schools have economics. It's one of the things that we care a lot about at Discover Economics. I actually ended up doing a lot of my lessons for economics at the
Oh, we've got a glitch. Wait a minute, Arun. I don't know if you can hear us. You've just frozen. He was just about to tell us something really interesting there. We are besieged by technical stuff this morning. Susan, what's going on? I don't know if Arun can hear us and rejoin us or whatever, but he's definitely frozen. He's definitely frozen. Bear with us. Hopefully he will jump back on. Don't know if you want to take Arun out and come back in, Susan, or what the best thing to do is. He's back. No, he's muted. Hello, you dropped off. You're back.
Yeah, I don't know what happened. I'm at a university. It's supposed to have good Wi-Fi.
It's interesting. So they just decided to cut you off. But we'll take you right back to what you were saying. You didn't necessarily want to study economics, but that is part of your mission, to get economics into all the schools you can. So tell me more.
Yes, so on Discover Economics, what we're trying to do there is to increase access to economics. So only half of state schools in the UK have access to economics. Have you got any chance of studying it? And economics is currently not on the national curriculum anywhere. It sort of shows up in this extra bit of personal, social health and economics education. But the economics is the one part of that that's actually optional, that you don't have to teach. And because a lot of schools don't have anyone who can teach it, as you said yourself, Claire, it's one of those things that's seen it's for geeks. People don't really understand it. If you're not sure yourself, do you really want to be teaching it to 14-year-olds or 16-year-olds who are going to ask you difficult questions you can't answer? Maybe not. So it's often just not taught at all. And that's just a disaster, because you end up with kids going through their entire school career learning zero economics, having no chance to understand these questions about government debts and finances and all of these things that then sound big and scary. And then we're asked to vote, and parties will tell us, well, we're going to spend £20 billion on this or £5 billion here. is that big? Is that small? Does that make
Yeah.
sense? Is that a good idea? Who knows? It's just not a good way to end up. As one, I care about it because as a profession, economists are not very representative, and we have a lot of power. There is a government economic service who are really important in making decisions about what government policy looks like. And if we're not representative as a profession, that's going to be a problem for the set of people who are in the room when those kind of decisions and conversations are happening. But
Right.
second, just even if you don't care about any of that, it matters in terms of, as a citizen, you need to vote, you need to make decisions. It helps to understand these questions and understand actually what is important, how should I evaluate these things, what makes sense, what doesn't. If you haven't learned any economics, it's really hard to kind of say anything about that or think about it.
Indeed. We're going to get into the tax in a minute, but before we do that, you've just touched on something very important to you personally, diversity. Now, last week we had Professor Dieter Helm, and he talked about not being a mainstream economist. That struck Susan's ears immediately as interesting. So who are the mainstream economists, and would you put yourself in that category?
I mean, I guess there's different ways to think about diversity. I think it's obviously true in all contexts of life. What do we mean by diversity? And there's one which is diversity of thought, and that's a hard thing to always measure because there's obviously a set of things that are just wrong, right? So we just said like diversity of thought in maths. Well, there are different ways to approach mathematical questions, but we all kind of agree there's one answer to 2 + 2, and it's 4. And so there are some things where we have to it's hard to know what exactly the right space should be, what things should count as diverse and what not. But certainly the thing that's very clear is just we don't have good diversity from the perspective of very visible, observable things. There's not very good socioeconomic diversity in the UK in terms of who studies economics. There's not very good regional diversity either. I actually can't remember. I think the numbers that we have don't include Scotland because the education is devolved separately for Scotland versus England and Wales. But across England and Wales, there's a big split in terms of where you get access to economics. It's much more common in the southeast of England than it is across Wales or the north and Midlands of England. We don't have good diversity in terms of gender. So about 1 in 3, only about 1 in 3 economists is a woman. We're studying economics as a woman. We don't have good demographic kind of characteristics in terms of ethnicities. So in terms of very visible things, it's clearly not as diverse as it could be and should be. And that clearly will matter because we know that your backgrounds, your experiences affect how you think and the approaches and the way you see the world. That will clearly feed through to then the things that people will think about. We've done some work actually recently, separate from my tax work, thinking about what do economists study? Like what kind of questions do we answer? How much do we study questions, for example, around ethnicity and race? And we see that compared to some other social sciences, the share in economics is pretty low. So it's about 2% of our work covers that at all. Compared to sociology, for example, that's about 8%. They have about 8%. And so we're looking at actually how much of that is driven by who's studying economics. If you have a set of people studying and researching economics who don't have some of those characteristics, they're not going to be as excited about them. We have the privilege as academics, for me certainly, of being able to study things I'm excited about, things that I care about. And if I have an experience or something, I think, oh, that's interesting, I want to look into it more, I can go and do that. If I've never thought about the question, it's just never occurred to me, I'm not going to go and study it. And so there's good evidence that, while in quotes women's issues are clearly not things that only women have to either think about or should study, it is the case that when there became more women studying economics and researching economics, we started having more research in, oh, well, what are the issues around female labor supply, a wage gap between men and women? Those kind of questions came up. Why are people paid differently? Is a question you ask when you are paid differently, or when you think about the fact that you know people who are paid differently. And so it really matters, the lack of diversity, or the currently kind of really lack of diversity. It's improving, things are improving, but it is still the case that we're not as diverse as a profession as we should be. And that's, I think, why it's really important to try to demystify economics, explain that actually really, in a way I'm the wrong example to be here because I'm going to come and talk to you about tax, but actually economics is about the understanding of human behavior and why we make decisions, what decisions we make, how they interact with each other, how do we think, and what do we do. That's really what economics is about. One example of that is how do we use how are our behaviors affected by being taxed, and what does the impact of tax have on public services. That's the bit that I spend my time, a big part of what I spend my time researching. But fundamentally, economics is about so much more. And if people understood that, they might be more inclined to get involved and to get excited about it, because economics lets you study climate change. It lets you study racial justice. It lets you study prisons and alcoholism and anything you can think of, you can pick up somewhere in economics. People are studying those questions in economics. And so it's really important that breadth is really represented in what people get to hear about economics. Otherwise, they only hear the economic correspondent come on the news to say, inflation's up, growth is down. And they go, well, okay, some numbers gone up, some numbers gone down. How does that affect my life? And again, people understand, my loaf of bread has become more expensive. My gas is more expensive to heat my home. And they feel that. But when, inflation, some number somewhere out there has gone up by some number, that's not really the thing that they're experiencing in their lives. It doesn't directly tie to that. And growth is the really hard one here. growth matters, because growth, what it means to us as economists is what's the total amount of stuff we as a country are producing. And that matters because if it's not going up very fast, we're not getting collectively richer, and we can't then figure out how to help distribute that pie across people. If we're not getting more money, then we haven't got more money to share out between people. But from a day-to-day perspective, if growth is 5% or 1%, how does that affect my life? That's what I want to know. Is, what's happened to my wage bill? That's what, if I'm not getting paid more, it doesn't matter to me what growth is out there somewhere. It's hard to feel that it matters, even though it does have impact on what government budgets look like. It's hard to feel it as an individual, and that's why I think some of those things are off-putting, because people only hear it in those kind of very abstract contexts.
And then they hear that word tax and they go, like me, I mean, I just get into a cold sweat. How much do I owe the taxman? It's very weird, this area that most of us run from, because it's an absolutely fascinating subject and it connects to so many other things, as you've just said, Arun. But you are very, very interested in wealth tax. Can you outline exactly what that is, what that takes in?
Yeah, so let me sort of step back first and sort of help you think about how tax works currently in the UK. So the three biggest taxes in the UK are income tax. That's a tax on any money you earn from any sources, so if you're working for somebody, for example, but also on money that you get from wealth. So if I own shares in a company and I get paid dividends, or if I'm a landlord and I get paid rent, then that gets taxed as well to income tax. Second tax is national insurance contributions. That's another kind of tax on income, but only on income from work. So again, if I'm working full-time on the minimum wage, I'm paying that income tax for working, and I'm also paying national insurance contributions. By contrast, it doesn't apply to income from wealth. So if I, for example, am a landlord and I'm renting my house to someone on minimum wage, I'll pay income tax, but I won't pay national insurance contributions, which is slightly odd. Doesn't really make a lot of sense. We can go back to that if you want to. And then the third big tax in the UK is VAT, which is value-added tax. It's the tax that we all pay when we buy stuff. So when you buy most things, there are lots of exemptions. So a lot of food that you buy in a supermarket is not covered. But if you go to a restaurant, for example, you'll notice that line at the end that says VAT or something like that, and that will be telling you that's some tax that's being paid. So basically, money that we earn and money that we spend is taxed. What we don't tax, as I kind of highlighted, and then there's a chunk of other stuff that's taxes on firms and other things, but they're actually collectively a lot smaller. But what we don't tax as effectively as I was sort of describing is wealth. So wealth is the value of the collective stuff that we own. So if I own a house and I have a pension and I have maybe I own some shares in a company, all of those things add up to make up my wealth. Maybe I run a business and I own the business. So those are all collectively my wealth. We tax income from that wealth, but we don't do it perfectly because, as I described, we don't tax it to national insurance contributions. So the level of tax that somebody who's getting most of their money from wealth, if I'm getting most of my money from being paid in dividends and being receiving rent, then I'm paying a lower tax rate on average than somebody who's getting their money from work. But then the other thing is, particularly for the very wealthiest, what they can do, what they naturally have an incentive to do is, if I have just more wealth than I'm ever going to spend, you end up in a situation where this is wealth where, what I'll do is I'll invest in things that increase in value. That increase in value we call a capital gain. There is a tax on capital gains. It's called capital gains tax, sensibly enough. But we tax that only at the point that I sell the asset. It makes sense. It's kind of hard to track the value of the asset year on year. It can be annoying to do that. And so instead what we say is, look, it's just convenient. We'll wait till the value is increased. And when I've sold it, and then we'll just say, this is the increase in value, we'll tax that. If I'm really wealthy, I probably just have more assets than I'm ever going to either spend or sell in my life. So I'm not going to pay the VAT because I'm not selling all these assets to go and buy stuff with them. I'm also not going to pay capital gains tax on them because I'm just never going to sell those assets. I just have, a landed estate if you're in Scotland, for example, or something like that. That's just not ever covered. What we said, one of the things I did a few years ago was to run an organisation called the Wealth Tax Commission, together with Professor Andy Summers at the LSE and Emma Chamberlain, who's a barrister in London. And together we kind of studied the question of whether the UK should have a wealth tax. And a wealth tax would mean not just a tax on the income that comes from wealth, not just a tax on increase in values, because those things, there are reasons why those things can work, but there are problems in the way they work at the moment. But is there a case in the UK for a tax that's just on wealth if you have enough of it, just because you own that wealth? So if I have a wealth of, say, £11 million, we might say a threshold and say, the first £10 million is tax-free. So most people are not going to pay this. But for the people who are above that threshold, just tax the bit above the threshold. So if I had £11 million and we had a 1% tax, we would take just the £1 million at the top. That's the bit that we're going to tax. And a 1% tax would tax 10%. We take 1%, we take £10,000. So £10,000 for somebody at £11 million. It's a tiny fraction of what they have in total. But doing something like that there's a few reasons why you might want to do something like that. So one is, from a fairness perspective, those are the people with the kind of biggest wallets. They have the most money around. And so if we're thinking about trying to raise money for public services, for tackling climate change, for whatever social goals you're interested in, they might be most able to pay. Second thing is, from a kind of structural standpoint, the current tax system isn't taxing them as much because their income is coming from, or their kind of assets are in the form of wealth that isn't taxed as heavily as work is taxed. And so that's another reason why you want to do it. And then the third thing is just in terms of just what does that revenue number look like? If we were thinking about spending some money in the future, if you were to have a 1% tax on just the wealth above £10 million, you'd affect about 22,000 people in the UK. So it's about 0.04%, tiny fraction of the UK. But the amount of money you'd raise from them, even at a 1% tax a year, would be as much as you'd get from a 1.5p increase in the rate of income tax for everybody.
Wow.
So you get kind of £11 billion ish. So it's a lot of money that you can raise from this very tiny amount.
Yeah, it'd be amazing to be able to tap into that. So why is it not happening? Big question.
I mean, there are some administrative things, but we at the Commission worked through kind of how you would deal with them. I think the biggest thing is the politics, frankly. It's just a question of, we have to decide who it is we want to tax and what we want the structure to look like. I think there are people who are advocating for it. As an academic, my job is to kind of explain how these things work, how they could work, what the kind of technical advantages and disadvantages are, and then the campaigners can, in whichever directions, say they really want it or really don't want it.
Sure.
I mean, I think one of the things that makes it harder politically is that it's not as common. Income taxes are fairly standard. We've had an income tax in the UK since 1799. So at this point, no one's going to argue that an income tax isn't feasible or doable. But people can argue, well, we couldn't do a wealth tax, and we haven't got one at the moment. So maybe we can't. We don't know. Until you implement it, you can't try it. And almost surely the first one you implement won't work as well as the second version of it, because you iterate these things. We built the income tax, into, as I say, 1799. It didn't work perfectly. There were lots of problems with it. We've since adjusted it and tweaked it and tried to improve it, and it's still, people will still talk about the fact there are kind of gaps in the way the system works. So you shouldn't imagine that what you'll get on day one is something working kind of perfectly and functioning. But because of that, I think that means that the kind of attraction to doing it is lower, because if I'm a politician thinking I need some money tomorrow, I could either say, HMRC, could you adjust some rate somewhere? That HMRC is the tax office. Could you adjust some rate somewhere by a penny or something and bring in some cash? And the next year the money rolls in and they can spend the money on things. Or they can say, can we do this complicated thing that might be a good thing to do, but isn't going to pay off for a few years because it's going to take some while to set up. The money comes in further down the line. And people will be, the people who complain about it will complain really loudly because it's a new thing and they're going to be annoyed about it. They're often people with quite a loud voice, in the sense that they have good connections that allow them to, when they say, oh, I'm going to leave the country or something, people listen and write that down and publish it in newspapers. But also, you have all that pain and you won't have any of the return on it for a few years while you're setting this thing up. You'll have a couple of years where you're waiting around, and that makes it harder. It's just like less attractive. You have to have someone who really has the political will to say, I want to do this. It's important to me to do this. I'm going to do it anyway.
So I want to bring Susan in a second, but I just want to ask you, are any other nations using a wealth tax at the moment? Is there something that we can say, look, empirical evidence that this actually does yield?
Yes, I mean, so actually there's quite a few countries that have it. There are 4 countries in the OECD currently. So this is a group of kind of wealthy countries that have it. And there's also other countries around the world, but where the UK might not feel as comfortable looking to them and saying, oh, it exists in some Latin American country, for example. That doesn't mean you shouldn't, but some people would say, well, that's not a good comparison. There's 4 countries currently in the OECD that have it. One of the points that's often brought up is that it was the case that more countries in the OECD had them, and they've kind of reduced in the number of their existence. And that's part that we looked at that very carefully when we took evidence at the Commission. And what we kind of learned from looking at what had happened in those other countries is that if you want to design a wealth tax, you have to think very carefully about what its aims are and how you kind of guard it against what we kind of described as erosion, the idea that people pick away at little bits of it and make little holes in it that make it less effective as a tax. And so what you see about other countries that have had wealth taxes, often they set the thresholds quite low. So by low, it still wasn't covering the majority of the population, but it might be covering, say, 20% of the population. That means that you have to make that practical, if you're going to measure everyone's wealth or the 20% of people's wealth every year and kind of get that written down, calculate their tax, you're going to have to take some shortcuts. You can't possibly value everyone's, that larger share of people's assets accurately. And for most people, their assets are quite simple. A lot of people don't have any assets, but if you have assets, typically it'll be a house and a pension, maybe. Those are the things you would have. Those are pretty easy to value. You can get a pension statement from the pension provider. Your house can be done kind of somewhat easily by Zoopla or equivalent. Just calculate the value by looking at what does someone else's house down the road sell for. I can guess what the value of my house is because there's a bunch of houses on my street that look the same. And that works great for the average person, but it doesn't work that well at the very top end of the distribution. And it misses out the really complicated things to value. if I have a private business that it's not traded, it's just a business that I run, but it's actually quite large. I now employ kind of 30, 40 people. We're making quite good money. What is it worth? It's actually a business also, it's a tech business. It's got IP, it's an intellectual property that will be worth something one day. One day it might sell for a lot. So how much should I value this? Those things are harder. They're doable, but they're harder. And if when we're trying to make a decision about that, we're not just focused on a small group of them that we're trying to value, we're saying, well, we need a system that's going to cover those, but also cover the many small plumbers, accountants, whatever you can think of, people who are working in their own small businesses. You're covering all of those. You need to take some shortcuts and say, like, here's a simple rule. We're going to just look at the value of the assets that the business owns, and we'll just apply it to that, or something like that. You can do that. That's very easy. Then you can make a tax that works for the majority of people in terms of it being very administrable. But what it means is it misses out the people at the very top, because for those kinds of people, the assets they have are not going to be covered very well by these shortcuts. And so what we said at the Commission was, in the UK, where we have a capital gains tax and we have an inheritance tax, we can tax most wealth for most people reasonably effectively. We could do better, and there are things that we should be doing, like changing the way we tax capital gains. We could expand national insurance contributions to cover those sources of investment income that we probably should be doing, because it's a bit weird that we don't. But the case for a wealth tax in the UK, if you want a wealth tax in the UK, is specifically at the very top end of the distribution. So we're thinking about people with wealth sort of above £10 million, or thereabouts. At that point, that's where those other taxes aren't as effective. So just to give you an example, inheritance tax is a tax that's paid on the death of somebody if they own enough assets.
Yeah.
So if you own more than, as a couple, if you own more than about £1 million, you start to kind of come into the system. So before that, you pay nothing. Above that, you start to pay. And you pay what's a 40% rate on the bit above that point. So if you have £2 million, you paid nothing on the first million, you pay 40% on the next million, that's 20% on average. Now you'd think that number would then just keep going up. So if you had even more, if I have £3 million, I'm paying 40% on 2 million of it, so it goes up and so on. But what you see is that actually when you get to 20% at 2 million, it basically stays flat at 20% the whole way along until you get to about £7.5 million, and then it starts to decline till you get to about 10% at £10 million. And that's because there are kind of other problems with the way the tax is designed. There are other loopholes in there. And we could tackle some of those things directly. But what we said was, it's actually really hard to kind of not, however hard you work to tackle loopholes, the thing about them is that they pop up. You find new ones, you find people.
There'll be consequences for doing anything at all. Yeah.
And so we said that's where there's a case. If you want a case for a wealth tax, that's where there's a case for a wealth tax. So wealth tax can say, look, it's actually really hard to get around this, because if you still own that wealth, you don't have to, it's not depending on you dying. It's not depending on you passing it to somebody else. It's not depending on you selling it. It's just that you have the wealth. It's not depending on you structuring it in some illiquid way, by which we mean a way that is getting some value, but is not producing an income flow that we can tax. Even if you do all of those things, we can still tax it. And so we said that's the place where you'd want a wealth tax. If you were to do a wealth tax at that point, actually you could raise quite a lot of money. And so that's what we said at the Commission, was we would focus, if you're going to have a wealth tax in the UK, certainly we should fix the other taxes on wealth, but then we want to instead introduce additionally, if you're having a wealth tax, a tax that starts at a very high threshold. And that's not something we've got as much experience with worldwide. So it's harder to learn from other countries, other than to see specifically what went wrong and to bring those things in. So what we did was just to say, here are specifically some things we can see have gone wrong in other countries, and here's how we design it in a way that will kind of get around that and make use of other bits of tax legislation we have in the UK, so that we're building on things that we already know how to do.
God, I can't believe I'm actually interested in tax now. Come on, Susan, jump in.
Yeah, we've got a point from Ken Barker that says, if I had 10 million plus, I'm not hanging around in the UK. So it brings in that behavioural aspect, but also that the loss of capital would cancel out most of the benefits you listed. How do you want to answer that?
Yeah, I mean, we looked very explicitly at this question of, do people leave? How much do people leave? I think there's a couple of things to say there. So one is just the practical thing, which is everyone imagines that wealthy people are going to leave immediately. The empirical evidence is that's just not true, and we've done some work.
Why is it not true? Why are they not leaving then?
Well, so to say, so we've done quantitative work that was sort of number crunching. Here's what we see, and we see that people just weren't leaving. And then obviously people ask the question, well, why don't they all leave? So we did some qualitative work just that came out just a couple of weeks ago, looking, actually just interviewing a bunch of really wealthy people and saying, like, explain to us what are the things. We didn't ask you like about tax directly. We just said, what makes you choose to live in the UK? We took some people who've left already and said, why did you choose to leave? We also asked them towards the end if they hadn't mentioned tax, which actually none of them did in terms of their location choices. We asked them at the end anyway, actually tell us a bit about tax and how tax figures in your decisions. And what they said was, basically, the reason we live in the UK is we like the schools. We have small kids and we like the schools. We like the cultural scene. We like the kind of stable environment to do business. Maybe we run a business. We have family in the area. All these things, and the kind of the impression you basically get from people, which is quite sensible, is actually, if I have this much money, I can choose where I live. I can afford to choose where I live. The way I always think about it is, I'm not so wealthy that I can just make a decision about where I want to live unconstrained by anything else. I say, well, actually, what can I afford to do? And that's how I make my choices. And for most people on these kind of events, people who are probably listening to this, you'll be thinking, okay, what I'm making choices based on what can I afford.
Mm-hmm.
At some point, you get to a level of wealth where you can kind of afford to an extent what you want. And so then the question for you is not what can I afford, but what do I want? And sure, you'll grumble. Of course, nobody likes money to be taken away from them. But actually, on the flip side of that is, sure, you'll grumble. But on the other hand, if you weren't paying tax and instead the option was public services crumble, and when you need the NHS, because even if you have private healthcare, the day that you get hit by a car, you don't have there's another point where you're going to try and phone up and say, well, I've got this private health. You get whisked by an ambulance to the A&E. They're going to be the ones looking after you. I used to actually work for the ambulance service, and everyone, all classes, whoever you are, you're getting whipped to the same hospital.
Yeah.
If that hospital's falling apart, that's a problem for you.
So
there is still a value in having those public services.
It is a disconnect, isn't it? Because we all want better public services, but we actually don't really want to pay more tax. And when did that become a thing? Susan was talking about this to me earlier and just saying, was it always that way? Surely, and maybe we're putting on rose-tinted specs here, but was there a time when people were a bit more, I don't know, socially responsible and thought, I understand why I'm paying tax, and that's fair enough, and that's reasonable, because this is redistributing things and making sure that services are maintained and improved. Now we're the opposite. It appears that we're very much like, no, thank you, we don't want to pay any money for that, but we want that to be better.
Yeah, one of the reasons we were talking about it, Arun, was because that language change between tax being a duty that's paid to society and being part of it, and now pretty much every time you see the word tax in the media, it's always surrounded by the word burden. And that the idea of something weighing you down that's heavy rather than a duty that you need to be paying. And I'm just really interested in, was there a point in time that it was different, or has it always been like this, or are people just different depending on their mindset?
I mean, I think there's obviously a lot of kind of natural politics in this, which is you can, if you're trying to find a giveaway, everyone would like more money, right? Like being given money is a great thing. So if a politician can tell me, look, that person over there is taking money from you and I would give it back to you, that always sounds nice to you, right? There's then separately the bit which is what am I not getting instead? And we have to then do that connection of, well, what is it that you're not going to pay for? But particularly actually over the last,
Oh no, that was getting really interesting. Well, Arun, come back. I know he will come back, but he might flip it a bit later. Are you happy with that answer so far, Susan? Because I thought it was really interesting.
Yeah, one of the things that has come up in conversation before when we've been talking about tax is Arun's always said you can design a tax system to do whatever you want, but then it changes over time, and then it's hard to change it because you have people lobbying against change, or people, so you've got all those kind of interests in maintaining the sort of status quo or lobbying for change, and it's kind of like whose voice sometimes loud. Sorry, Arun, I was filling in.
Yeah, good. I'm glad you did. I'm not sure why the connection's so bad. I'm at the LSE today, so I'm going to blame them. Just because that is where I am. But the thing I was
in London, you should stay in Warwick.
Yeah, exactly. But the thing I was going to say was the other part to it is the state is also a lot larger than it used to be. So there's many more services we expect from the state, and I think that's a good thing. It wasn't the case that the state was providing education to everybody 200 years ago, right? Like this isn't the world we used to live in. So we now have that. The NHS is obviously huge. It is the biggest single thing we spend money on as a society, and it's because healthcare is more expensive. We have fortunately found lots of ways to keep people alive and in better health until quite old age. And that's great. But if you're spending all that money on keeping people alive and in better health, and we have all these new medicines that we've discovered, or new treatments and techniques we have, that costs money. And so we can say, well, we don't want to live in that society. We just want to accept that people will just die earlier and we don't really care. Then that's a world you could choose to live in. But if we say, well, we know that we can do better, and we know that people could stay alive, and we don't want to just condemn them to not, at the end, we always are making a choice, right? At the end of the day, there are, at the margin, some kind of new treatment that will be created, and it will be, £1 million a year for somebody, and there'll be a point where the NHS says that we can't afford to spend that. So it is still the case that we have to make those choices. But where do you want to draw that line is part of the question. If we want to spend in those things, I mean, there is some spending on sort of armaments, defense, whatever you want to call that sector. We need to spend money on public infrastructure. We've now decided, we've now realized that climate change is a serious issue, and we need to spend money to do things that allow us to live our lives as much as we'd like to live in the current way, while also not emitting as much carbon in doing that. All of these things are costly. And so if we want to be have the state involved in doing all of these things, then we need to pay for it. We wouldn't expect to go to a restaurant and get the food for free. So there's no reason we should expect to show up at school and expect it to be free. It's free at the point of use, but it's not free in the sense that teachers can just give their time up for nothing. They still need to be paid. And the deal that we make collectively as a society is that we pay for teachers by us all putting in some money every year. And the years that we have kids who are of that age, they're getting access to schools. And if I don't have kids, it's still the case that I benefit from living in a society where the other people, the younger people in the society, are getting educated, being able to work, being able to, when I'm in old age, look after me, or serve me coffee, or whatever it is that I like. All of these things that you might expect or enjoy in a society work because we have this social fabric. And then the question is is understanding what that looks like, deciding what we want it to look like, and then working out, well, how do we pay for that? And the only way you can choose to pay for something like that is ultimately through tax. And so it's a question of who should then bear that kind of cost, which it is a cost, but it's a cost that we're getting. We shouldn't think of it as a pure cost. It's a cost that's being spent for the receipt of a service.
We've got Susan with a question, but Susan, I've just spotted another question. Don't know if you want to read that out.
Oh, we're going to go over time, Claire. Do you think that's all right?
Yeah.
Is that all right? Yeah, we'll run over.
All right.
So Samuel Mara has asked, economic theory suggests that a lot of earnings at the top of the distribution are essentially economic rents, which is effectively money that's not associated with effort, so should be efficient to collect, as it wouldn't discourage effort. Do you take this view as well? And if so, why is it difficult to collect these monies in practice?
This is a deeply technical question. So economic rent basically means money that you are getting not because of the effort you're expending, but just sort of by being in that job. Just whoever is in that job, for example, would get that money. That's kind of roughly the way to think about it. And so an example of this is people who are bankers in London clearly do work many long hours. They do work hard. They are typically pretty smart people. It's also the case that being a banker in London pays a lot of money, and there are lots of people who might do that job slightly as well, or might do it just as well, and would still help make a lot of profit for the bank. So, the role of being a banker in London pays a lot of money, sort of independently almost of who's in it. You can't have somebody in it who can't add up or whatever, but there's a huge range of people who get in there. So in that sense, there's a rent there, which is that people who are just in that industry, that industry as an industry, because it's so successful and because it's located in London, there's in that case, we have this thing that we call agglomeration rents. There's a value to banks choosing to be in London. When all the other kind of finance industry is in London, do I want to be the one bank that says, oh, it's actually cheaper for me to move to Sheffield? I mean, Sheffield's a lovely city, but do I want to be the one place there? No, I'm going to be in London because that's where everything else is. So you can afford to tax that industry and people there slightly more heavily on the basis that they're not, in London, on the basis that they're not going to just immediately jump and say, well, it's much cheaper to be somewhere else, but there's no resources and nothing else there. So that's certainly true in theory. The practicalities of it are, what is the level of that rent? So it's not that you shouldn't do it, but it's calculating, well, how much is economic rent and how do you design a tax that taxes that bit and not something else? In the end, the way we design taxes isn't really around trying to pick those things out. It's not a bad thing to try to pick out, but it's a really hard thing to pick out. And it is also not a thing that's stable over time. It changes over time, so you have to kind of keep calculating it and updating it. And so the way we tend to think about the design of taxes is to work out, what are we trying to pay for? Because one, we're not trying to just tax people for the sake of taxing them. What are we trying to pay for? How much does that cost? And what is a design for a tax system that is fair, in the sense that then the fairness means two things, right? So fairness means, what do the rich pay compared to the poor? And there's different views on what that ratio should look like, but that's a question. The other is kind of what we call horizontal fairness. It's actually, among two rich people, is it that they're paying the same amount? So in my example of a banker probably earning a high income is probably paying 47% of tax rate. They've got a 45% income tax rate. They've got a 2% national insurance rate. So it's 47%. On the other hand, someone working in private equity, which, we may not understand, but it's something vaguely like banking. I can explain it in detail, but is, roughly speaking, the finance industry again is paying a much lower rate because their income is taxed as a capital gain, and capital gains are taxed at a much lower rate, and so they're paying a tax rate of 20% on that same amount of money. And so if you're a banker, you say, look, one question is how much do I get paid? How much tax should I pay compared to someone who's got a low income? The other is why am I paying a very different level of tax to somebody who's also earning the same amount of money as me? This doesn't make much sense. So there's fairness that we need to think about in designing the tax system. There's efficiency, which is, how do you design taxes in a way that doesn't distort a lot of behavior in bad ways? So how do you design a tax that doesn't lead to everyone leaving, for example, in that earlier question, or doesn't lead to people not setting up businesses that are productive, or whatever else it would be? So thinking out all of those things and trying to make sure we're not creating economic harm by doing it. And the third thing, as I say, is that revenue aspect. There's kind of a fourth thing, which is important in certain contexts, which is, we also design some taxes specifically to change behavior. So carbon taxes are there for the very specific purpose, not of raising money, but an ideal carbon tax is one which raises £0 and 0 pence, because it's taxed out all of the carbon. I mean, we probably actually have amount of carbon we can spend every year. So we're probably not actually trying to get to zero. But the ideal carbon tax is one that kind of takes us to whatever our target level of carbon is, and doesn't have any, there's no more carbon than that being emitted. And so it's over time eroding the amount of tax you're getting from it. But that's good. That's what we want. We don't raise carbon taxes to raise money. We raise carbon taxes to try to reduce carbon. And so that's the fourth kind of reason we have tax.
So can I ask, so the question I was going to ask before I put Samuel's in, but I thought Samuel's was more important, was years more than 10 years ago now, there was a big report done called the Murley's Review, looking at the tax system and how to simplify it. And it was generally well received by lots of different parties. And then there was something set up called the Office for Tax Simplification that had a go at trying to simplify some taxes, but maybe not as many were achieved. And then that was axed in the Liz Truss budget, quasi-Kwarteng's budget, I should say, or state. It wasn't officially a budget. And no one kind of noticed. No one seems to have said anything about the fact that it's gone. Have we just given up on simplifying the tax system, do you think?
I think the thing about simplifying the tax system is a lot of so two things. So one is a lot of the complexity is because of the way we choose to design taxes. So there's people may have heard of and probably don't understand this IR35 thing. This IR35 thing that's about who is an employee, who's not an employee, is all driven by the fact that it matters in the tax system. If we said you're taxed the same, whether you're an employee or whether you're self-employed as a contractor or whatever else, people wouldn't spend time gaming it, and we wouldn't have to have reams and reams of legislation trying to police it. Because we say, actually, you get a lower tax rate if you're self-employed than if you're employed. You get even lower tax rate if you incorporate, if you form a company, you get even lower tax rate. Those things mean that there are incentives to try to restructure yourself in ways that get a lower tax rate. So if we were to just flatten those things out, then you wouldn't have those. And so that's the best way to simplify it, but it requires a politician to stand up and say they're going to do it. And then it also requires the public and media to be grown up about it and say that's quite a good move. So Philip Hammond actually tried to do some of this in the 2017 budget, which was one that he kind of basically got U-turned on. They announced they were going to try to reduce some of the gap between employed and self-employed people in terms of the tax rates. And the media came out and said, "Oh, you're taxing white van man, blah blah blah. This is a disaster for kind of entrepreneurship and whatever else." It's just about treating people in the same way. But it does require a kind of sensible discussion in the media. So that's one part. The other part,
it's never going to happen.
It's not going to happen. No, it's not going to happen. But I think it's important that we don't just blame politicians, because politicians do try and do good things. And that was an example of something that was like a totally sensible tax move. And
So, Claire, why is it never going to happen? Why do we never get any sensible conversations in the media?
It's not about the media. The media reflects society, Susan. And frankly, we can't have a grown-up conversation about it in society because we all want stuff for nothing, or for somebody else to get taxed more than us. So as long as human behavior exists and all the complexities of everything everywhere, happening all at the same time that Arun's just spoken about, it is so complicated. I really pity the poor policymakers and the politicians that have to come up with some sort of sensible system. And I really pity the economists like Arun who try to figure out, wait a minute, if we do this tweak here, we're going to make something unintended or bad happen over there. So I don't know. I just feel, what a complicated but fascinating insight it's been into tax. I think we've got to release the hostage now, Susan. Arun has been sitting through technical difficulties, and for me, it's been absolutely fascinating.
Sorry,
Who knew tax was so interesting, and wealth tax in particular? Can we come back to this, Susan? Do you think maybe we should just
definitely? There was another question I was going to ask you about hypothecated tax, because that's something that everyone thinks that national insurance goes to the NHS and it doesn't. And I think there's so many misunderstandings that, we're trying to do the economy in plain English. Let's get to some of those terms. And also, if anyone's listening and we've used words today that you think actually they really need clarifying, we've used too much jargon today, because
Arun's been good though. I've been listening hard. No, he's explained.
You've done a grand job of explaining, but I just wonder if there were a few terms that we didn't explain. If they've snuck out there, please do challenge us and make sure that we're sticking to our mission of being in plain English. Claire, I'll leave to you for the last question that you're asking everyone.
Okay, I'm asking everyone that's on this, Arun, what do we need to keep in mind? What's the takeaway that you want everyone listening to this, viewing this, to take away with them today? What's the big headline?
I think the big headline, I'm going to disappoint you by not talking about tax. I'm talking instead about economics, which is, I think the big headline for me is, economics is fascinating. It's about the world around you, about your lives, about the lives of everybody. And so I really just want to encourage people to get involved, to learn more about it. Go visit our website at Discover Economics. It's all about trying to increase access to economics. But I think it's really important that people get engaged, because if you're not engaged, you're really going to struggle to understand these kind of difficult issues, because they are very technical. And that's going to matter for your ability to make all kinds of decisions, including decisions that will come up later this year in terms of where to vote.
I couldn't agree with you more. Absolutely beautifully done. Arun, thank you so much. Absolutely fascinating, really brilliant, and very energized as well, I've got to say. So Susan, over to you to say what's happening. Are we doing something next week? I can't even remember.
And next week, we're having a week off. Just to take stock and look at our stats and all those kind of things. But yeah, I'd just like to thank you both. And we're back the following week with Dr. Andrea Barry talking about some of the things that came up in the Dieter Helm talk about intergenerational tensions. And so Andrea Barry works for the Youth Futures Foundation and is the principal economist there. So she's going to be telling us what a principal economist does as part of her interview with us or conversation with us. So yes, thank you very much, everybody. Thanks, Arun, for your time, and Claire, again, for your lively hosting. And we'll say for now, everybody, and we'll see you again soon.
Bye-bye.